All right, good afternoon, guys. Welcome to attend my online class session, Managerial Accounting. So let's get started. In the last class, we learned about the standard cost system, and we learned the cost variance. Well, actually, cost variance is actually the difference between the standard or budgeted cost and the actual cost. And in the last class, we primarily analyze the cost variance in direct material and direct labor. We know that the cost variance can be split into two parts: cost variance and efficiency variance, either to be favorable or unfavorable. Similarly, we learned the analysis to analyze direct labor variance, and we know total direct labor variance can also be separated into two parts: cost variance and efficiency variance. Well, today we will discuss the analysis of the manufacturing overhead variance. And as you have known, that manufacturing overhead can be separated into two parts: variable part and fixed part. So let's get started. First of all, let's get started in the variable part. So in a standard cost system, the manufacturing overhead allocated to production can be calculated as this: overhead allocated to production equals to standard overhead allocation rate times standard quantity of the allocation base allowed for actual output. In a standard cost system, the standard overhead allocation rate replaces the predetermined overhead allocation rate. But the concept is the same. It is a rate calculated during the budgeting process when other standards are determined. So let's begin with computing the fictitious company's standard variable and fixed overhead allocation rates. Cheerful Colors allocates overhead based on direct labor hours. The static budget that was presented in the last class indicated the expected production would be 50,000 batches of crayons. At that level of production and using the direct labor efficiency standard of 0.25 direct labor hours per batch, the company expected to incur 12,500 direct labor hours. Well, the standard budget also shows the budgeted variable overhead at $37,500 and budgeted fixed overhead at $25,000. We're using static budget amounts here because standards are set before the budgeting period. So the accountants at the company didn't know the actual production level for the year when the standards were set. So as I said, let's begin with the variable overhead variance. The company uses a similar approach to analyze the variable overhead flexible budget variance. As a as the same as the analysis to analyze the direct labor and direct material variance. Because direct material and direct labors are also variable cost. So, the approach is very similar. So if you can remember, as to the previous slide shows, yes, here it is. So this is the previous slide. You can see the company has a favorable in terms of variable overhead. The company has a favorable $8,840 favorable overhead. All right, here it is. So it means the company spends less than budgeted. Now, we have to analyze this favorable variance. The company computes the variable overhead cost and efficiency variances. If you can recall that the standard cost for variable overhead is $3 per direct hour, and 13,000 direct labor hours were budgeted for 52 batches of cranes in the flexible budgets. But the actual variable overhead cost was $30,160, and it took 10,400 direct labor hours to make these amounts of batches. So this slide is a summary. We can see from the first two entries, we know the standard cost standard and the efficiency standard, and the last two entries are the actual amount of direct labor hours and the actual cost of variable overhead. So similarly, we use the same formula to do this analysis. We can, first of all, calculate the variable overhead cost variance, which means the difference between the actual variable overhead and the standard variable overhead. For the actual overhead allocation incurred. So this variance measures how well the business keeps unit cost of variable overhead. So we use the similar formula, that is actual cost minus standard cost times actual quantity. We get a favorable $1,040 as the variable overhead cost variance. And similarly, next, we do the analysis on efficiency variance. And also, similarly, we use this formula to do the efficiency variance. Actual quantity minus standard quantity times standard cost. Then we get a favorable $7,800. So this slide summarizes how the company divides the 8,840 favorable variance overhead flexible budget variance into its cost and efficiency components. This 8,840 favorable variable overhead variance indicates the variable overhead costs were less than expected. To manage these companies' variable overhead costs, we need to get more insights. First, the company incurs $1,040 less than the expected actual variable overhead cost. And secondly, the workers made 52,000 batches of crayons in 10,400 hours instead of the budgeted 13,000 hours. Less hours. So less hours means higher efficiency. That is a favorable variance, efficiency variance. So management now may decide that the variable overhead cost variance is sufficiently small and doesn't warrant investigation, but the company may want to investigate the variance further to determine the reduction in cost was controllable or if the cost standards need to be updated. So the third production cost analyzed so far were variable costs. So the analysis were very similar to each of them for different for direct material, direct labor, and variable overhead. But now the company uses a slightly different approach to analyze the fixed overhead variance. And you need to remember that the fixed cost are not expected to change in total within the relevant range, but the per unit fixed overhead changes when there is a change in volume. So to analyze the fixed overhead costs, we will need these three amounts: actual fixed overhead cost incurred, budgeted fixed overhead cost, and allocated fixed overhead cost. So first of all, and I would say similarly, we do the cost variance. But the analysis of cost variance for fixed overhead is different. Well, we do not use actual cost minus standard cost times actual quantity, exact these things. No. Instead, we just use actual fixed overhead minus budgeted overhead. We get the difference to be a favorable $1,080. Well, this number is a favorable number because the company actually, spent less than budgeted for fixed overhead. Well, in terms of fixed overhead, for the first part, we do cost variance analysis, but for the second part, it would be a little bit different. It's no longer something like the efficiency variance. Instead, we use the analysis in volume variance because I said the total fixed cost doesn't change within the relevant range. The only thing that changes is the per unit fixed overhead as the volume changes, the total volume changes. So here, fixed overhead volume variance measures the difference between the budgeted fixed overhead and the amount of fixed overhead allocated to actual outputs. This variance measures how fixed overhead is allocated and the actual volume is not equal to budgeted volume. Using the standard overhead allocation rate for fixed overhead previously calculated, fixed overhead is allocated at $2 per direct labor hour, and each batch has an efficiency standard of 0.25 direct labor hours per batch. So the amount of fixed overhead allocated is $26,000. It is calculated as standard overhead allocation rate times standard quantity of the allocation base allowed for actual outputs. So the fixed overhead volume variance is calculated the budgeted fixed overhead minus allocated fixed overhead. we get a $1,000 favorable $1,000. Well, this number is also favorable because within this amount of fixed overhead, the company makes more batches of crayons than the originally budgeted amount. In other words, based on the standard of fixed overhead, the company has over-allocated fixed overhead by $1,000. Well, when overhead is adjusted at the end of the accounting period, the adjustment for over-allocation for overhead will decrease COGS because the adjustment is a decrease to an expense. The fixed overhead volume variance is favorable. So this variance, the fixed overhead volume variance, is not a cost variance and explains why fixed overhead is overallocated or underallocated. So this slide shows the fixed overhead volume variance for the company. The small blue triangle bounded by the lines represents budgeted fixed overhead, standard fixed overhead allocated, and standard direct labor hours lines represents favorable fixed overhead volume variance in this example. So finally, we can see this summary of total fixed overhead variance. It is composed of two components. First is cost variance, and the second is volume variance. All right. Now we have looked at the individual cost standards variances. Let's look at the big picture. This slide again showed the flexible budget variance for the product cost. It has direct material, direct labor, variable overhead, and fixed overhead. And this slide illustrates the relationships among the various product cost variance. But as you can see, that the fixed overhead volume variance is not included in this diagram. Because as previously stated, this variance is not a flexible budget variance, but a volume variance. It shows how allocating fixed costs on a per unit basis cause a difference between budgeted fixed overheads and allocated fixed overheads. The allocation causes overallocation or underallocation of fixed manufacturing overheads. All right, now that all the variances are summarized, the company can investigate the variance it feels that are important. So this is called management by exception because managers concentrate on the results that are outside the accepted parameters. In other words, the managers focus on the exceptions. Variances can be expressed as a percentage of a budgeted amount or a dollar amount. Many companies use a combination of percentage and dollar amounts. For example, the company may investigate any variances greater or less than 10% of budgeted amounts, or like a one $10,000 more or less. So in this example company, I mean the Careful Colors company, the standard is that the manager want to investigate any variances greater than $5,000. So these 5 items have the variances greater than $5,000. They are direct material cost variance, direct material efficiency variance, direct labor cost variance, direct labor efficiency variance, as well as variable overheads efficiency variance. So these 5 items are considered significant where the managers want to focus on. And to investigate these 5 entries, here are some possible questions that the managers want to ask. All right, the last part of this chapter. Let's see how to make journal entries in a standard cost system. So let's look at the different journal entries, how it differs. Management needs to know about the variances and addresses each problem. So the company records variances from standards as soon as possible. This means that the company needs to record direct material cost variance when the materials are purchased. It also means that work in process inventory is debited at standard input quantities and standard costs when the crayons are manufactured. Well, first of all, let's see the example transaction. The first one, direct material purchase. The journal entry to record direct material purchased has an emphasis on the cost of the material. This transaction records the debit to raw material inventory, which is recorded at the actual quantity of raw material purchased at the standard cost. So for the debited accounts, for the debited raw material inventory, the 65,000 pounds should be actual quantity of raw material purchased, and the unit cost $1.75 are standard cost. And in contrast, the credit to accounts payable is for the actual quantity of raw material purchased times actual cost times actual cost. And because this is the actual amount owed to the vendors. Maintaining raw material inventory at a higher standard cost and the accounts payable at a lower cost causes a difference. So this difference, as you know, is actually the direct material cost variance. So we credit or debit the direct material cost variance account to this number. This should be the difference. We should debit or credit this account to make this journal entry balanced. Okay, this is the example transaction 1. That is the purchase of direct material in order to record the cost variance, direct material cost variance. Next, the use of direct materials, usage of direct materials. And as you can see, this transaction is used to record the efficiency variance. Well, the journal entry to record the direct material usage has an emphasis on the quantity of the materials used. So in this transaction, the company debits work in process inventory for the standard cost at the standard quantity of 52,000 pounds of direct material that should have been used to make 52,000 batches of crayons. This maintains WIP inventory at standard cost. Raw material inventory is credited for the actual quantity of materials put into production line at the standard cost. Well, here it results in an unfavorable variance, that is the efficiency variance. So here, for unfavorable variance, we should debit this amount to make this journal entry balanced. So we debit direct material efficiency variance account for the difference. The next transaction is direct labor. In transaction 3, WIP inventory is debited for the $12 per hour standard cost of the 13,000 direct labor hours that should have been used for 52 batches, which is the standard quantity. Well, wage payable is credited for the actual cost because this is the amount where the company must pay the workers. The direct labor cost variance is unfavorable $20,800. The direct labor efficiency variance is credited for a favorable $31,200. Transaction 4, overhead incurred. This transaction, records the company's actual overhead cost. Manufacturer overhead is debited for the actual cost or actual overhead cost. That is 30,000, 160,000 actual overhead cost plus 23,920 actual fixed overhead cost. Well, that results to a total of $54,080. So in this transaction, we just need to debit manufacturing overheads for the actual amount. And various accounts should be credited. For example, the insurance cost or the rent. These are the various accounts to be credited. Well, next transaction, overhead allocated. This is pretty much straightforward. We just debit WIP inventory and credit manufacturing overhead. For the amounts, it should be standard overhead allocation rate times standard quantity of the allocation base for actual output. We get, in this example, we get $65,000. Well, next, completed goods. This transaction transfers the standard cost of 52,000 batches of crayons completed from WIP inventory to finished goods inventory. The amount transferred is the total standard cost for the 52,000 batches, including direct material, direct labor, and manufacturing overheads. in this transaction, we just transfer the WIP inventory, transfer the completed goods from WIP inventory to finished goods inventory, which is pretty much straightforward, right? And also, the next transaction should be to record the COGS. This transaction transfers the COGS at the standard cost of $6 per batch. This transaction assumes that all batches produced were sold in that year. And for simplicity purpose, the sales journal entry has not been presented here. Because, with a presented COGS entry, we always have a sales journal entry, but here, for simplicity purpose, it is not shown here. And finally, as you know, we need to do the adjustments. So the last transaction, adjust manufacturer overhead account and records the overhead variances. All of the manufacturer overhead variances are favorable. So they are all credited. The debit to manufacturer overhead indicates that the actual overhead costs debited to the accounts were less than the allocated amount credited to that amount, and overhead was over allocated. So the account had a credit balance and has to be debited to bring it to zero balance. When overhead is under allocated, the adjustment to manufacturer overhead should be a credit, and the net amount of the overhead variances is unfavorable. So let's look at the standard cost income statement. How does the income statement look like in a standard cost system? And let's back to this example again. The company's top management needs to know about the company's cost variances. First, the operating income is the same as the slides previously shown in the previous class. Let me find it. It's oh, right here. Yes. The operating income in the income statements under standard cost system, is it is the same amount as shown here. Well, these statements, as you can see, start with the sales revenue at standard and subtract the unfavorable sales revenue variance of $5,200, and it uses the actual sales revenue. Actual sales revenue. And next, the statement shows the COGS at standard cost. This is the COGS at standard cost. And then the statement separately lists each manufacturing cost variance, followed by COGS at actual cost. The variances with credit balance are shown in the brackets because they are contra expenses and decreases the expenses, COGS. And at the end of the period, all these variances accounts, which are temporary accounts, should be closed to 0. All right, this is the income statement in a standard cost system. And this is also the very last part of this chapter. So I think that's all of this class and all of this chapter. So please let me know if you have any questions before I leave. No? All good. All right. No more questions?
Thank you, Professor.
Okay, thank you. Thank you for your attendance again. This is the end of this class, so I will see you next Monday. All right, bye-bye.